Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode number 169 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you everything you need to know from the past week in the world of financial markets and financial planning. Matt is out on a business trip today, so Nick is back to join us again for this week's episode. So welcome back, Nick.
Good to be here, as always.
Before we begin, as always, just want to take the first few minutes to recap the performance for the month and the year of the major indexes that we track. And these numbers are as of the market close on September 27th, and this data is from YCharts. S&P 500 index down 7.8% for September and down 23.5% for the year. The Dow down 7.5% for the month and down 19.8% for the year. The NASDAQ Composite Index down 8.4% for the month and down 30.8% for the year. The IWM ETF that tracks the Russell 2000 Index down 10.2% for the month, down 25.9% for the year. And then the Vanguard All World ex-United States ETF also down 10.2% for the month and down 27.6% for the year. 3-month Treasury rate at 3.35%, the 2-year Treasury rate at 4.3%, which we'll get into here in a little bit. The 10-year Treasury rate sitting at 3.97%. So we've seen a pretty big move up in yields, Nick, since the Federal Reserve meeting, obviously. That's the highest that the 2 years been in quite some time. And I think the 1-year Treasury might be even closer to like 4.5% right now.
Yeah, I think you're right, yeah.
Which I'm going to look up right now. But what is your takeaway from that?
Yeah, I mean, there's so many directions I could go with this, right? I want to say it's not surprising, but it is a little surprising just to see how drastic the moves have been in the bond market. It'll be interesting to see how it plays out on the grand scale, and I'm trying not to lead too much into our research pieces because I think we're going to get into it a little bit more.
We won't spoil it for listeners then. But yeah, I'm just curious. I want to pull up this 1-year Treasury yield just to see where we're at, because that was at like 4.2% last week when I checked it.
Yeah.
Let's see here. I can find this quick on YCharts.
Yeah, it'll be interesting. I've got a couple pieces on bonds to talk about, and there's been a lot more conversation about the TINA trade and whether or not the TINA trade's going away.
Yeah.
For listeners who don't know, the TINA is a fun, almost like a ha-ha financial acronym that is there is no alternative, and that's what
that's
a lot of financiers have said over the past
not
decade.
the case anymore.
And yeah, when you're looking at a 4.3 on a 2-year, that's an alternative, right?
Yeah. So it's actually the 1-year Treasury rate is at 4.16%, but I think this is what people have been looking for a long time, Nick.
Yeah.
We get the question all the time, hey, I have some money that I need to spend to put a down payment on a house or buy a new car in a year or two. And now you have options, because the 1-year Treasury rate last year was 0.09% on this day 1 year ago.
Yeah, which is pretty wild to think about.
Wild's an understatement, right?
Yeah.
That's a huge move.
Yeah.
That's a massive move. So in the long-term average, wow, YCharts got a lot of good information here. The long-term average of the 2-year Treasury is 2.85%. So obviously well above that. But if people are looking for some yield, some safety, to save for near-term expenses, which I would define as anywhere, maybe even as high as less than 18, 16 months, just to get a little bit of juice on that money rather than the savings account, which has gone up as well. But CD rates higher right now, so not all bad. I know it hasn't been a fun year in terms of investments for people, but now there are some other options to get some yield that people have been starved for the past several years.
For a decade.
Yeah, exactly. So moving on to big headlines, current events from the week. The S&P 500 has been down the last 6 days in a row as major market indices have retested their June low. On the S&P 500, at least intraday, we made a new low, but I believe it closed back above it. So we're just hovering right around those June lows right now, and I think that this is a crucial time, and it's almost a make or break decision time for the S&P 500 and the other indices that we follow closely, because if we break lower, I think you might see another quick fall of another 5 to 10%, or we hold and we move higher into the end of the year. That's still to be seen, but I think this is a pretty big area for the markets right now.
Yeah, definitely. And there's a number of shops that I saw yesterday came out with quite bearish takes. BlackRock, Goldman, Morgan Stanley's been bearish for a while, but I saw a Goldman forecast that they think it could even test the pre-COVID highs of the market. So there are people on both sides of the fence, but I think I feel like I see that a lot whenever you have a big sell-off. It's like, oh, all of a sudden now Goldman and Morgan and BlackRock, oh, now we're bearish. It's like, but you weren't 2 weeks ago
right
that bearish, and now it's all they get back in the headlines. So
yeah, it's almost like they kind of act like retail investors almost. And they flip from bullish to bearish pretty quickly. And if we did retest those highs prior to COVID, Nick, that's only 7.5% away from where we are right now.
Right. It's not, when you look at it on a chart, it's from where we are and sentiment in the market. I don't think it's wild to see it testing that level.
No, I don't think so either. And I think that would be, kind of shocking for people that would, erase all of the gains in the S&P 500 going back to, February, early February of 2020.
Yeah.
But that stuff happens. That's not uncommon for that to happen. So we have to be open to that. And this would be, I think, a logical place where it makes sense for it to do that with the weak seasonality in September, the beginning of October, before we go into a seasonally strong period for the markets. It would not shock me if we did go back to the pre-COVID highs, and then that's right where the market stopped and started to move higher again.
Yeah, and then we'll be in earnings and kind of bounce from there. So
yep. Do you want to talk just briefly about what's been happening in the currency markets? I know we've seen some crazy moves, obviously in the British pound. So what's going on there? And is it something that people need to be aware of or pay attention to at all?
Yeah, I don't think anyone needs to stress about it too much from their personal retirement accounts. I don't think of it in that way, partly because the underlying reasoning behind a lot of the currency volatility that you've probably seen in the headlines is the strong U.S. dollar. I could have grabbed a number of different headlines, but I grabbed one from Reuters, and I'll just read a couple little highlights for you. The British pound fell to an all-time low. The Japanese monetary intervention, they intervened to prop up a falling yen, and the euro's deeper plunge into dollar parity. So you have the pound, you have the yen, you have the euro. At the same time, the U.S. dollar is trading at a 2-decade peak. And then this last quote I'll read for you is, the U.S. dollar has dominated due to soaring U.S. interest rates, a comparatively strong American economy, and demand for a haven as global financial markets have turned more turbulent this year. That's really the story here. It's that from an economic point, and I know it's hard to say this and hard to even hear this whenever the market pricing looks the way it is, but our economy is sitting in a better place than a lot of these other places, particularly Europe, with everything that's going on in the Russian-Ukraine war and their energy crisis. And if you look at England economic numbers, their GDP, their employment, their retail spending, all of that stuff is drastically
more negative
and a worse situation than we are in. So
right.
That's really what's driving this volatility and this fluctuation that you're seeing in the currency markets.
Yeah, and I think, you know, I'll have Jenna throw a chart up for the people watching on YouTube right now that I'll grab for after the podcast. But pretty much this year, the U.S. dollar and the S&P 500 have been completely inverse of each other.
Yeah.
So with the U.S. dollar rising, markets falling, and when we did get rallies, the bear market rallies, if you want to call that, earlier in March of this year and then in June until about a month ago, the dollar was weaker. Mm-hmm. And it's not always like that, though. You know, if you look on a long-term chart, there have been, of course, instances where the U.S. dollar has been going up and the S&P 500 goes up. S&P 500 goes down and the dollar goes down. But this year in 2022, it's been a pretty stark inverse correlation between those two assets. So we'll go ahead and throw that chart up on the YouTube page for people to look at that as well.
Yeah, that's an interesting observation.
Yeah. Moving on to tweets, articles, and research from this week. The first thing I had was a tweet from Sentiment Trader on September 22nd. And he says, Mom and Pop have given up. This week joins just 4 others in 35 years, with more than 60% of respondents being despondent or bearish in the AAII survey. 1 year returns after the others: 22.4%, 31.5%, 7.4%, and 56.9%. But of course, this time is different. And I know some people may be getting frustrated with us on, you know, how many contrarian points that we've made this year, and we're still going through a tough environment in the market. But we have to remember that this stuff, you know, takes a long time to play out, right? It doesn't necessarily mean that right when someone tweets this or puts out this piece of research, meaning that, hey, right away we're going to go back to all-time highs. And a lot of these stats that we've had is, you know, it references 1 year returns after this happens, which, you know, we still have a while to get there, right?
Yeah.
But again, just another note to show just the extreme pessimism in the market, and eventually, you know, that's gonna turn around.
Yeah, and I think you make a great point there, is and just to kind of reiterate your point, is that often we and what we do here and how we invest, we're looking very long term.
Right.
I mean, 7, 10 years, 5, 7. When you look at a 5-year chart, it's a lot different than it's so easy to get wrapped up in a month of selling, a bad year, a bad quarter. If you take a deep breath, you look at some of these indicators and you think, in 3 years, will I be happy that I bought now, or things like that? That's just kind of
and if we were day traders or swing traders for our clients, then I would have a completely different outlook, and I would have had a different tone this whole year. But I think that's really important, and I'm glad that you mentioned it, is that because we are so long term, you know, we know that the market is in always a long-term 2 steps forward, 1 step back type of situation. And I do believe we're in that 1 step back situation right now. Unfortunately. Next tweet I had was from Callie Cox on September 6th. And Callie said, if you've ever wondered why the 10-year yield matters for tech and crypto, here's why. Increase in rates equals increase of cost of money equals the decrease of future value over time. And many of us invest in tech for what it could be in the future, not what it is right now. So kind of going back to our point that you just made, Nick. And I think that this is a great tweet that Callie put out that simply explains to investors why interest rates matter for future profitability. So for those that aren't too in tune with financial statements, you know, interest expense is a line item on the income statement that can be pretty much a direct contributor to reducing, net profits for a company. So a company could
Especially
be
a small one.
right.
Yeah.
A company could be growing their revenues at a pretty decent clip, but if their borrowing costs go up, then it's going to slow their earnings or potentially even go into negative earnings growth, because that line item obviously comes after revenue. And there's a lot more that goes into it than that. But just for simplicity's sake, I want people to understand why higher interest rates are quote unquote a headwind for stock prices and for future profitability. Because that's an expense just like any other operating expense that a company has. I think that's why you've seen, such a sell-off in the markets this year primarily is just because of the rise in interest rates.
They're trying to price in the rise in interest rates. The market's trying to price that in. Yeah.
So,
or has been trying to price it in.
Last thing I had is a piece of research from Ally Financial. And it's sellers of investments based on generations. So this goes back for the last 12 months from August of this year. So the research says generational selling opportunity. Intriguing statistics. Seems just about every millennial sold some or all of their investments. Could have to do with life stages, but hard to guess what is specifically driving this. The other key thing that sticks out in this chart, which I'll have Jenna put up on the YouTube page and it'll be in our show notes, is that aside from millennials, everyone else held tight. That gels with my previous observations about the difference between very bearish surveys versus relatively minor movement in equity allocations and margin positions. So what you're going to see if you're watching on YouTube is that of the millennials that they surveyed, 49% said that they're selling some or all of their investments within the past 12 months. Gen X, that falls to 21%, Gen Z, 17%, and Boomers, 13%. So this is kind of, the older, the wiser type of situation.
That's a huge bummer for millennials. That's not a good percentage.
No, and I think it goes back to, millennials. Obviously, they're still young. They're still getting their feet under them with their jobs and everything and their money, but they haven't, for the most part, I don't think taken that step to reach out to a professional or reach out to an advisor to learn about this stuff. Yeah. And, this makes me think of a gentleman that we worked with, that we do consulting with another company. It's a publicly traded company. They have an employee stock purchase plan. And when he first started, when he was like 20 years old, his manager just told him to max out how much, stock of this company that he could buy each and every week because the company gave him a match too. And then he didn't touch it for his like 30 or 40 year working career. And when he retired, he started getting checks in the mail for like 30 or 40 grand every quarter. And he didn't know what it was. And it ended up being his dividend check from this company stock that he had been buying his whole career. And,
that's all right.
and which means he had, $5, $6, $7 million of this company stock, and he didn't even know it.
Yeah.
But that just goes to show you that the longer term mindset that you have, you can be rewarded. And I'm not saying being short term and trading and investing over 3 to 6 to 9 month periods can't be successful. But if this isn't your everyday job, it makes it a lot harder to be shorter term like that.
Yeah, absolutely. And I think the only other point I can think of would be houses. I bet a bunch of millennials had to sell their investments. Maybe it was even a small individual account where they were just accruing some money and they had to sell it for a down payment on the house. But that would be the only thing I can think that makes sense, other than what you're talking about with poor decisions, I guess.
Yeah.
That's
And
the way to say that.
Just talking about housing really quick, I saw this yesterday, but the average mortgage right now for a new house, Nick, is over 7%.
Oh yeah.
Right now.
Yeah.
Which is hard.
the number,
something's
the number. I read some research yesterday about this, and I considered putting in the podcast, but I didn't go with it. But it was something like the median home price in the U.S. relative to the median salary would be 40. Like the mortgage payment, including PMI and everything, would be like 44% of their income.
Mm-hmm. I saw that as well.
Level.
Which is tough. Which, I mean, something has to give, and I know that a lot of people aren't very happy, or especially millennials, younger generations, people that are looking to buy a home, are not happy with the Fed Chair Jerome Powell right now, because he's making it pretty close to unaffordable to buy a new home. But the other side of the coin too is, Nick, that I think most of the people in America took advantage of refinancing when interest rates or mortgage rates were near 2 to 3%. Yep. So people that are in their homes right now are fine, but it's just that group of new people looking for a new home makes it extremely challenging. And, you know, I've been, and Matt's been the same way throughout this whole year, pounding the table that, you know, we didn't think we were going to have another housing crisis like we did in 07 and 08, because it's a different type of environment. They're different problems. But, you know, I could see over the next several years housing prices come in by 20 to 30%. And that wouldn't surprise me. Obviously, different situation than it was in 07 or 08, but something's going to have to give here eventually.
Yeah, I tend to agree. We'll see. It'll be interesting.
I'll turn it over to you.
Yeah, so my first piece here is on institutional selling pressure in 2022, and this is from S&P Global Market Intelligence Research Group. This is actually, I got this from a former colleague, so I'm very familiar with this report. I've worked with this data for a little more than 6 years. So I'll have Jenna throw the chart up here, and I'll read there's one line that they had in the report, which is as follows: against a backdrop of growing inflation fears, selling by institutional investors accelerated to its highest levels in 2022. The interesting thing for me here is the chart, which shows you capital flows across institutions, hedge funds, and retail. And I'm going to break this down somewhat quickly. I could go way deep in the weeds. Again, I'm very, very familiar with this data, but the way to think about retail is your average mom and pop. You know, if I were to go and open a Fidelity account and trade a couple stocks, I'd be a retail investor. Hedge fund, think your classic Wall Street, the guys that are long and short and really fast, high turnover. Their turnover in a portfolio could be upwards of 150%, which is pretty crazy. The opposite of how we do things in wealth management, right? And then your institutions are your big boys, the big money, Fidelity Investment Group, Capital Group, BlackRock, big, huge institutions with billions and billions and billions of dollars. Like the Capital Group, we're talking like $800 billion, something around that level. So that's what and the institutional money oftentimes, not always, but they can really move a stock up or down. And so I just thought this chart was interesting when you see it, particularly over the S&P 500, as to how much selling these institutions have contributed over this past year. It makes a lot of sense when you see the price action as well. And it's very interesting where we are sitting right now with what we talked about in the bond market. I wonder if these institutions, generally speaking, were much more overweight equities over the past 10 years because of the TINA trade. There is no alternative. So it'd be interesting to see if this turns around, but I don't know if you have any thoughts on that.
Yeah, and the only thought I would have for you is if you could get your hands on it, or from your colleague, I'd like to see this chart over the last decade or last 2 decades to see, how well the institutions are on timing the market and buying and selling near highs and lows. So I think that would be interesting for listeners to see, is if we can get our hands on this chart going back a decade or two, that would be pretty interesting and probably eye-opening for people.
Yeah, it would be. And I can tell you from experience that they will not be able to pull that off.
Yeah.
Yeah, the tracking the historical data is very difficult in that field, because the way that they put this report together, actually just doing this chart is pretty challenging. And the reason it's challenging is because S&P builds this report, and it's hard data. It's based on their clients, right? They're insiders, so their clients are publicly traded stocks, right? So, Apple, Amazon, ConocoPhillips, like all these big companies.
Mm-hmm.
When I was there, they had 800 plus corporate clients, right? So S&P 500, they had 800, right? When I was there, we had about that many. They probably have a few more now, I would guess. And the way they pull the data in is based on custodial data from each individual ticker. And then they have to take, and you have to build these firewalls, these safeguards, because it's insider data. So you got to be really careful so they don't share that. So speaking from experience, I know how difficult that chart is, which is...
Well, never mind. Hopefully we'll get there eventually.
Yeah, I would love it if they did, because it is interesting. It is interesting data, but that's kind of how the data's built. So that leads me kind of into that 60-40 conversation that we were trending, which is a tweet from Bloomberg's Lisa Abramowitz. This is a tweet from yesterday. And it's about investment grade bond yields shooting higher. We have a chart here for you, and Lisa says the following: U.S. investment grade bond yields are the highest since 2009 at 5.63. That's more than double where they were at the end of last year. It's hard to overstate just how fast some of these moves have been, even if the trading has been orderly and consistent. My comments here were which I've mentioned a couple times now, is the Tina trade, and then thinking about the 60-40 portfolio, and just having a little chuckle when just thinking about, well, it's like 2-3 months ago, and you're seeing research, is the 60-40 portfolio dead, right? I mean, you see moves like this, it's like, oh, a 60-40 looks pretty good right now.
Yeah.
So
yeah.
What do you think?
No, I think it's just interesting. Obviously, with the move up in yields, corporate debt is gonna yield more as well. And I think it's like using like a security like LQD, which is the iShares investment grade corporate bond ETF. It's down 22% this year. I mean, that's a lot for corporate bonds, right?
Yeah.
For investment grade corporate bonds. Yeah. So it's been a really, really challenging year for investors, simply because of the weakness in the bond market. Yeah. So yeah, interesting point. We'll see how high these things go, but I think the bank, Europe, I think, is already talking about buying bonds again. So providing fiscal stimulus. So I wonder how far the U.S. is behind them in doing that, because I don't know. I just don't know how they can keep up this aggressive rate hike for too much longer.
Yeah, we'll see. They seem pretty determined to get inflation under control.
Yeah,
so.
Powell had a complete change of character, which, I think he, for the most part during the COVID crisis, did a good job in navigating it. But obviously, I think he overstayed his welcome a little bit with the stimulus that was provided, and now he's trying to make up for that and catch up on that mistake. And I don't think that's a secret. Yeah. So it's obviously
they missed inflation. They missed.
Yeah.
They should have hiked a year sooner.
Yeah, it's too bad that we are where we are right now, but these things have consequences when you have too much money sloshing around for too long.
Yep. You're already seeing the parallels between Powell and Volcker start to come out.
I know. That was only which is, again, that's like comparing apples to oranges, in my opinion.
It is very much so, but
nonetheless,
some interesting comments I'm sure are out there. My last piece is just staying on the trend of the bond market. This is a piece from Compound Research from the 26th, and it's showing a big chart, a big matrix of government bond yields from 2020 to now. And Charlie says this: in May 2020, there were 21 countries around the world with negative yields. Switzerland actually had a negative yield on its 50-year government bond. And in parentheses, he says that's not a typo.
That is crazy.
That's pretty wild.
You're paying 38 bips to lock up your money for 50 years.
Yeah.
Wow.
Wild. He says, fast forward to today, and there's only one country with negative yields remaining, Japan. But that too may soon change, with inflation in Japan rising to its highest level since 2014 at 3%. The Matrix, when you look at it, it really speaks for itself. It's one of the reasons I like it, is because you could just look at it and really get a sense as to how fast countries around the world have had to adapt their monetary policy to deal with the rampant inflation worldwide. It's not just in the U.S., worldwide, to deal with this massive shock to our lives with COVID. The supply shock, the demand shock. I mean, it's just such a massive shock in the economic cycle. And we talked about it. I remember talking about it 6 months ago. Right. And looking at charts and just trying to explain how massive that is when you see jobs fall that much and come back that quick. I mean, we've not seen anything like it in history. And I think this chart illustrates that and what the central banking policy has had to do to try to keep up with it. So what are your thoughts?
I'm just kind of scanning this chart here that you put in here. It's interesting. The Czech Republic 1-year bond is paying 6.63% right now, which is wild. It's just wild to think about. Like, that's, and that's what I'm wondering, at what point do people just start loading into treasuries, because we haven't seen it yet. I mean, I would have thought that once, the 2-year got over maybe like 3%, people would have started buying, but here we are sitting at 4.2% or whatever it is. And yields can continue to go up, and no one's really piling into treasury at this point. So, is it going to take it, the 2-year or the 5-year getting up to 5 or 6%, to which at that point you're starting to approach the long-term average of stocks? Yeah. So it's like, at what point are people going to start loading into treasuries? And I think it's just a matter of time until they do. But I wonder when the uncle point's going to be. Yeah.
The other thing that's interesting to think about, that supply and demand perspective from the treasuries, is thinking about how much more the Fed has on their balance sheet. I mean, they can really flood the market and let that balance sheet taper at a much more aggressive rate than they have. So that will definitely impact that, right? So it'll be interesting. But yeah, the 6.6%, that's pretty. That's wild. That's wild. Definitely and I'm sure our listeners know this, but the Czech Republic 2-year yield and 1-year yield is not as safe as the United States 2 and 1-year yield. Correct. So yeah. Thanks for throwing that out there. It's not a guarantee. It's not like U.S. Treasury rates. That's why U.S. Treasury rates are the safe haven, is because we've never defaulted. Other governments have defaulted, so just got to throw that out there. Faith and credit, the U.S. government. Well, just to keep it short for listeners here, Nick, and we got a couple other things to get to today. I'm going to push my financial planning topic of the week to the next time we record. So with that, anything else before we leave it off for the week? No, that was great. Thanks for having me again. Yeah, it's always fun. Thanks for joining us, and thanks everybody for tuning in to episode number 169 of the Independent Advisors podcast. We hope you all have a wonderful week. And this Friday will mark the end of a trading quarter number 3. So next week we will be entering Q4, which again, just how it's been every end of quarter this year. People are excited to start fresh and get into a new quarter, hoping that something changes from a stock market return standpoint. Indeed. So
Have a great weekend, everybody.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved. Advisory services offered through Commonwealth Financial Network, a registered investment advisor.